Hello, good afternoon, everybody. So today we're going to talk about the Singapore banks. Okay, one of the banks, UOB, has already announced its earnings last week for second quarter, I believe. So let us now take a look at the chart of UOB Bank. Okay, the famous and favorite question is 可以买了吗？够低了吗？Now, before we answer is it time to buy and whatnot, right? Let us understand how the share price moves. Okay, we will go through the earnings together first, as usual, before we talk about the risk factor. Now, earnings of UOB Bank, the financial, let me see, this one is the latest one, right? Just give me one moment, guys, very fast. Okay, yes, this is the latest one. All right, so latest financial, I'm going to go through a few key metrics with you. There isn't good news if you compare second quarter to first quarter 2023. Everything is down, is a bit too exaggerating, but we do not see strong growth, and it was quite a flattish results, and that probably explains why the share price of UOB was down on the earnings results after the earnings results. Okay, so let me just go through a few key financials with you. So this is performance by geography, as you can see from here. Okay, year-on-year growth, to me, I won't say it's not important. It's good to know. But if you want to look at any slowdown in any business, okay, banks lah, REITs lah, you have got what other company are, all companies. Okay, you want to see the weakness, okay, start of the weakness, you look at quarter on quarter, Q on Q. Y is year on year. Okay, year on year is good to know, but if you want to know, you want to see the small changes, right? Q on Q, quarter on quarter is key. As you can see, it is down. Singapore down, Malaysia down, Thailand up, Indonesia down, Vietnam up strongly. But this is after they integrate with they consolidate with the city group, which they bought over their Southeast Asia business, ASEAN business. Okay, so this is the latest, and you can see it's a mixed bag. It is not the strongest. Okay, Greater China, wow, 26% growth. All right, so this is what you want to know. It's not everything everywhere growing. Also, this is the first point to note. Now, second is their net interest income. As you can see, the net interest income, okay, by percentage is flattish. 0.02, I don't think is a big deal. Okay, if it drop 1 percentage point or half a percentage point, yes, let's sit up and take notice. But this one is 0.02. So nothing to shout about. We go to the fee income, it also dropped 1 percentage point. So again, nothing to shout about. So it is not a very strong performance by the bank. Okay, take a look at this. Non-trade related fees decline on softer lending activities. Guys, this is the key. Okay, it's a bank bank is you lend people money to make money, right? So if the lending activity slow down, okay, it means lesser people are loaning money. Okay, which means potentially the economy may be slowing down or maybe lukewarm, definitely not growing. So this is something as a watch out, because if the economy is going on a decline slowly, you don't expect the banks to do well. That will be closer to 2018 kind of performance in the bank shares. Okay, now you buy bank shares to make money, correct or not? So this is the 2018 performance. Okay, you can see the date is on top. Okay, I mouse over the peak for you. April 2018. Okay, the low is November 2018. So this is the kind of decline that you may expect to see, but not okay. Never mind. Later we come back to the chart. Okay, so this is something that you have to keep in mind. If going forward, it keep getting softer and softer and softer lending activities, that means business is slowing down. Okay, not only the banks, guys. Is okay. The banks are the barometer of the economy. It means the general economy is slowing down. Okay, now the rest are also nothing to shout about, the earnings. Okay, and you have got trading and investment income, record quarter, I from what they have reported, record quarter, but it is a slight decline from 43 percentage point, right? So again, not so much of a, okay, quarter on quarter, not so much of a growth. But if you talk about year-on-year comparison, shoot up lah, very high. Okay, but if you talk about quarter on quarter, you can see start to be flattish already. So that is why lah, the earnings day, the share price didn't perform. Okay, core expense ratio. Expense, you don't go up too much is good, but they usually don't have any problem with cost and expense control. In fact, they highlighted that they have spent don't know how many millions, hundreds of millions of dollars for the consolidation with Citi, which is one off. So it will start to taper off. Right. Non-performing asset. Now, non-performing asset, take note of the ratio. Okay, if it is stable at 1.6, 1.7, 1.6, then it's still fine. But you do see if from 1.5, it started to go to 1.6, hang on there. So it's a slight gain and held there for 3 quarters. So you take note of the trend of the NPL ratio, which is the non-performing loan. Okay, non-performing loan, that means certain company, certain industry may be in trouble and they are unable to, not unable there is a risk that they may not be able to fulfill their debt obligation. Okay, so you have to watch this next quarter and also look at DBS, look at OCBC report. If you don't tick up, maintain is good. Okay, even if it tick up slightly, later I show you. If you tick up slightly, it may be a problem. Okay, how do you identify a problem? Later I show you. Okay, let's talk about the total allowance on loan. Did they provide more to cover? I think there is a slight increase. Okay, this slight increase 164 to 102 quarter on quarter. You see, they improvise more. So, is it something somewhere, or they see something that we don't see? They improvise more. Let's see. Preemptive general allowance set aside to maintain prudent. Okay lah. So it is a preemptive. So it's nothing on the horizon that they saw that it's not doing well. Okay. So this one also we take it as a non-event. Allowance coverage. Okay, allowance coverage is 200%, more than enough cash to cover, no problem. Gross loan, so I don't know. Okay, Greater China exposure, 1% of the group loans. Okay, now guys, don't think 1% of the group loan, even if they go belly up, the China developers go belly up, it has no effect on the Singapore bank shares. It is not. Or later, I share with you what happened in 2015. Then you will be able to appreciate that even a small percentage will drag the sentiment lower. Okay, so far, we look at Greater China, right? It's like no problem. Only 1% of the group loans. And exposure to commercial real estate, only 8% of their loan is commercial real estate, with 3.6% in Singapore. The rest other country, United States, also no problem. It will not affect the bank performance. The Singapore one is the one to watch out for. So if you invest in the Singapore banks, then you can expect the performance to tie very closely to what happened in Singapore, because most of their earnings are from Singapore. Okay, so the LTV, loan to valuation, is around 50 to 60%. That means people actually already pay up 50 to 60% of their loan, and therefore if the commercial property price slump by 50%, which in my memory, only 1997 that Thai baht currency turmoil trigger that kind of level. Otherwise, okay guys, I stand to be corrected. Even if we're talking about the 2008 financial tsunami, I don't see the loan to I don't see the property prices, commercial or residential, plunge by 50%. I don't remember seeing that. It was a quick dip in that 2008 year. And yes, there are some fire sale, but generally the prices are holding up quite resiliently. I don't think I see 50%, except 1997. Okay, so seems like with the LTV at 50 to 60% should be stable for this 8% loan. Okay, let's take a look at total funding, not important to me, liquidity ratio. This one usually, okay guys, when I say not important to me, it's because throughout the years, whenever I look at their report, their earnings, right, they usually, it's not the problem. that causes the bank shares to come crashing down. Later, I share with you what will cause the share price to plunge. Okay, so all these are MAS control. They want them to maintain certain capital ratio, so therefore they have to do it. So usually no problem. Now, the next important thing is dividend. Now, we buy bank shares this year is because we want to have high dividends. So to achieve high dividends, high dividends yield, the bank must be willing to pay the dividend. Okay, and what kind of payout ratio are we looking at? You can see for UOB, it is close to 50%. It's at 49% for the past 3 years. Okay, 2 years. Okay, and 2023 should be also 49%. And first half 23, you already can see that their income, the payout amount, sorry, not their income, their payout amount is already more, okay, it's already past the halfway point in 2022. So we can expect 2023, the final dividend to surpass 2022 level. So in any case, I believe, okay, based on the share price, okay, based on the current share price now, we are looking at about 4.9 to 5%, close to 5% dividend yield on UOB right now. Okay, right now. So I believe their share price, if there is no specific problem with the world economy or any bearish catalyst, I believe the share price for the banks should be supported by the high dividend this year. Okay, as you can see right here, it is already more than half of last year's half. Okay, more than last year's half. Also, with the second half 2023 coming in, we can expect to be more than 2022 dividends, okay, payout for us. Okay, so I believe this dividend is what is supporting the price, and you can see the rest of the performance is actually flattish, nothing to shout about. Now, let me now go to the chart and show you the history of this UOB bank. Okay, now there are a few times where the bank come crashing down. When I say crashing down, right, it's more than 30%. So the last time it did that is the COVID-19, which everybody is familiar, so I shall not talk about it. Then 2018, there was also I don't think we can call this a crash. This one probably is just the decline in share price, market correction. Why? It's because the years before, okay, 2016, 17 are all up. So 2018, 有一点调整, some correction is normal. Okay, so this 2018 is also the time where I think the Singapore economy wasn't doing well. It was flattish. It was slightly coming down. And technical recession, if I am not wrong, I stand to be corrected. Okay, so that was the reason why the bank shares was flattish and wasn't doing quite well. And you see, it didn't crash to the 30% level. Now, the other 2 times where it crashed to the 30% level, right? Okay, pardon my scrolling. Let me just scroll nicely for you so that we are all on the same page. Okay, we talk about the sovereign wealth crisis. 2011 is very close to the 2008. Now, 2008, I will also not explain. This one is very clear cut. It was a financial tsunami. 2011 is the sovereign debt crisis, okay, in Europe, which you have the Portugal, the Italy, Greece, and Spain. And finally, I think only Greece went to borrow money from IMF, and they gone through the austerity measures. The rest are still surviving. Okay, so 2011 was a bearish year for all equities. Okay, all equities, not the bank's problem. It's the whole world. We are all worried about a second financial tsunami coming. But in the end, don't have. End of the year 2011, everything is fine. And then, 2012 onwards, shoot up again. Okay, now let's talk about the more recent one, 2015. This one is due to the high oil price. The crashing of the oil price. Okay, I have got the information right here. So you can see this is 2015, 2016. Okay, what happened during that year is because the 3 banks' oil and gas exposure are credit negative. Okay, and they point to reduce asset quality amid currently oil price. So the low oil price affected the local oil and gas industry a lot. A lot of them go belly up. bankrupt and all that. And I think if my memory serves me right, Sembawang Corp, Marine, Keppel Corp, all of them kena tekan also. Let's take a look at this. Okay, we don't have Sembawang Corp, Marine with us right now. They already merged with the Keppel Fell. So let's take a look at Keppel Corp 2015. There you go. Okay, so this was the time where the oil price came crashing down. All these oil and gas players all borrow money from bank one, right? A lot of them have bad loans. Okay, so that is what dragged the UOB price down a lot. Not only UOB, DBS, OCBC also the same. All gonna drag down because of this oil price. Okay, so I will show you more news, right? So this is the news of that year, 2015, 2016. And then you can see the oil and gas. Now, why I show you this slide? This is taken from the 2016, 2015 presentation, results presentation slide. Okay, the total loan out to this oil and gas industry is only 3.6%. Okay, the Chinese one just now you saw, right, is 1%. So even though it is a small percentage of the total loan, right, if the whole industry is sour, it will pull the bank shares down because overreaction, overreaction. Okay, so but you can see after that, nothing happened. The share price still managed to go up 2016, 2017 as the oil and gas industry got sorted out after the collapse. Then rescue all these come in and oil price start to climb up. And also the oil price come down other than OPEC policy change, and there is another factor, which is the Chinese slowdown. The China economy slowed down as well. So it was a double whammy for the world economy, because when oil price comes down, right, it means that lesser demand. Why lesser demand? Economy slowing down. And who's the number 2 economy? China. So China slowed down, so the whole thesis was no demand for oil. Then the oil keep coming lower and lower and lower. Okay, I keep talking about oil. I might as well show you the oil price. Then you can appreciate what happened that time. Okay, knowing the past can help you prepare for the future. There you go. You see, from $113 all the way down to $35 per barrel. Okay, $35 per barrel. So that was the cost, okay, and the effect right here, and it will sort itself out. So from what I have seen over the decades is, once the problem is identified, share price will react negatively to it, but give it time. After it work out a solution, the stock price will go back up again. Okay, so this is the 2015, how it happened, and why the share price came down. Right, so from the results of last week, October results, earnings for UOB, next 2 weeks, I think we have got OCBC and DBS also reporting. So what we want to see is, are they the same? Flattish is still okay. So long you don't come crashing down, your income, everything coming down, then it's no good. Okay, so right now it is trading at the 50-day moving average line, and it is at this support level, which is about $26.30. So this is the first support level. If this break, right, guys, watch out for any bearish catalyst that may show up. Maybe it could be the what do you call that? The property. Okay, the property in Singapore, a lot of people default, cannot pay their loan, or high unemployment. High unemployment shoot up, people cannot pay for their mortgage. Interest rate shoot up, people cannot pay for their mortgage. More and more default, more and more mortgage sales. Then maybe we will be able to see the share price touching the $24 now, which is the differently blue line. Okay, the 200-week moving average. So in short, as a summary, if you want to see the share price at very steep discount for you to buy, it requires a very big bearish catalyst like industry in trouble, sovereign wealth crisis, sovereign debt crisis, or the Singapore economy slowdown. Then you will be able to pick up at very low price. Okay, even for the Singapore economy slowing down, right, you can see it is a 20% pullback. Okay, you want to see 30% kind or more than 30% kind, it requires industry level kind of catastrophe. Okay, so based on what I shared with you right now, let me do a conclusion. So the conclusion right now is if the earnings starts to be flattish, it is still making money, it will still be paying out good dividends, then you will see the share price supported at about 5% dividend yield level, okay, which is at current price thereabouts. Okay, so if it comes down all the way to $24, very simple. You take last year's dividend, you divide by the share price, you get the yield. No way. I don't think it will rise up to 7-6%. Okay, so 5+% plus minus, that is the sweet spot for the bank's dividends at the moment. Okay, so if there's any bearish catalyst, then I will do another video to highlight. Right now, there is some problem brewing here and there, but we haven't seen the full effect yet. Okay, like slowing down economy, for example. Now we've got two wars fighting, which is Ukraine and Russia, and you have got Hamas and Israel. Okay, so these are the watch out areas. All right, so that's all for today. If I see anything interesting, I will share with you again. Probably my next video will be on iFast, how we pick up iFast. Okay, so guys, have a good time. Hey, if you find this video informative and helpful, please help me like the video and also share it with your friends, and also subscribe to our channel for the next upcoming video. Okay, so that's all for today, guys. Thank you very much. Bye.